The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. In just a matter of days, financial markets have gone from orderly to chaotic. The S&P 500 dropped to its lowest level in nearly a year, and the VIX, often called Wall Street's fear gauge, has spiked to levels not seen since the early months of the pandemic. For long-term investors, the natural question is, what's going on and what does it mean for portfolios? What strategies are investors turning to protect their portfolios? Well, to find out more, joining me now is Ritesh Ganeriwal, who is the head of investment advisory at Syfe. Ritesh, welcome back to the show.
Hi, Hongbin. Pleasure to be here.
Thank you so much for joining us. Ritesh, how are you viewing the current volatility in markets right now?
Unprecedented, right? Obviously, the recent volatility we've seen is kind of a direct response to the uncertainty in the U.S. trade policy. We saw the unveiling of Trump's reciprocal tariffs, and that has sent shockwaves through the global economy. And right after Liberation Day, which was April 2nd, the S&P 500, as you mentioned as well, has experienced its biggest two-day drop since the Great Depression. We're talking about more than, say, 80, 90 years. And just days later, following this 90-day reprieve and a set of exemptions, we have seen that there is a sharp reversal as well. So that is like the third largest one-day gain since 1948. Now, despite this rebound, obviously major indices remain under pressure, with NASDAQ and small caps experiencing the bear market territory, which is basically 20% down from their recent peak. So for us, I guess the market is a forward-looking barometer of economic expectations, right? And this initial sell-off reflects investor concerns that tariffs could actually disrupt global supply chains, push up costs, and reduce consumption, all of which could significantly dent corporate earnings, right? And in short, that basically means that we are looking at the probability of a recession that has increased quite meaningfully since the tariffs announcement. And while this short-term relief has helped markets kind of recover some ground, the overhang of this prolonged uncertainty means that we are likely to see continued volatility going forward as well.
Okay, well, then given the volatility we're seeing and the initial panic selling that we've seen, should investors still stay invested, or should they, take money out of their investments?
A very important question, and obviously one that is on top of mind for a lot of investors as well. First of all, it's worth remembering that markets hate uncertainty, and that's what you're seeing, right? The tariff announcements has introduced a high degree of it at a very sudden pace. So the panic selling that we have seen is a reaction to that, kind of a repricing of risk as investors reassess the impact of global growth and corporate earnings. Now, this is exactly also the time where it's crucial not to let these short-term noises kind of derail your long-term plans. And history has shown that markets do recover, often very sharply, once there is more clarity or a shift in sentiment. And in fact, we saw that play out just days after the sell-off, because this 90-day reprieve that I talked to you about sparked one of the biggest single-day rallies in decades, right? The S&P rose by 9.5% overnight trading. So should investors stay invested? I mean, absolutely. If you're investing with a long-term view and have a well-diversified portfolio, very, very important, having a well-diversified portfolio, staying the course is often the best strategy, because trying to time the market and getting out during this panic and then trying to jump back in, it rarely works, right? And often leads to missed opportunities.
Right. Then how do you approach asset allocation and diversification for clients who are risk adverse but want to stay invested during uncertain times?
Absolutely. So even before this volatility, we had been cautioning and warning clients against the growing concentration risks in major market indices such as S&P 500, which have become heavily reliant on Magnificent Seven mega-cap tech stocks. So while they have driven past returns, the concentration increases your downside risk as well. And that's why diversification is so critical. And this is what we incorporate in our kind of model equity 100 portfolios as well. We take a more globally diversified approach. We reduce reliance on a handful of US tech names and add exposure to more of these defensive and international market sectors as well, which is especially important during this changing global landscape. And beyond equities, we also see high quality fixed income as well positioned in the current environment, as well as gold continues to be that valuable safe haven asset. For the more risk-averse investors, as you pointed out, who still want some sort of market participation, we have like downside protected portfolios which use option strategies as well. And this helps clients to take exposure with built-in safeguards during market declines as well. So I would say the key is still to stay invested, but do so a little bit more smartly with the right balance of growth, protection, as well as diversification.
Ritesh, do you think investors often underestimate the importance of rebalancing during bear markets? I mean, what's the typical behavioral mistake you see?
They do. And often, they underestimate, as you said, right, how critical this rebalancing is, especially during bear markets. The most common behavioral mistake that we have seen is basically letting your emotion take over. And most of the folks tend to panic and either sell what's falling, so they think that this is a falling knife, so they sell. Or they hold on too tightly to what's been performing really well, allowing their portfolio to drift far from their intended kind of like asset allocation mix. So this is why rebalancing is like a quiet superpower of long-term investing. It's not just about buying and holding, it's about keeping your portfolio in balance as markets move. And without rebalancing, you can unintentionally take on more risk than what you're comfortable with, right? Like, talked about this concentration risks, etc. And if most of your returns are generated by these names, then obviously you become more geared towards them. So if equities have done well, they can end up dominating your portfolio allocation, meaning that increases in volatility right when you might want more stability.
Okay, well, Ritesh, a key question for our interview here. Then why might strategies like enhanced dollar cost averaging be especially effective in volatile markets? How effective is the EDCA strategy during bear markets or even sharp pullbacks?
So this enhanced dollar cost averaging strategy is a term that we have kind of like recently coined in response to how the markets have been behaving. And we did a bunch of back tests, etc., to see how efficient this strategy is as well. So when it comes to enhanced dollar cost averaging, or EDCA as we call it, it's especially effective in volatile and declining markets because it combines discipline with adaptability.
Right.
So in traditional DCA, you invest a fixed amount on a regular basis. And in EDCA, you increase the investment amount during sharp market declines. Essentially, you're buying more when the prices are lower. This approach actually helps you lower your average cost per unit and accelerates long-term returns once the market recovers. And that's the truth. Over a long period of time, you will see the market coming back up. So in bear markets or sharp pullbacks, EDCA actually turns volatility into an opportunity without you needing to be active about it, right? Like, and if you look back during, say, 2008 financial crisis and 2022 rate hike-driven sell-off, EDCA actually significantly outperformed both traditional DCA as well as lump sum investing. So, for instance, during the great financial crisis, EDCA actually yielded more than 80% returns compared to 60+ returns in traditional DCA and around 49% for lump sum investing.
Okay, right. So Ritesh, how would you respond to a skeptical investor who says, why not just invest lump sum during a crash?
It's a fair question. And in theory, actually, it's true. Investing a lump sum at the bottom of a crash sounds like the ideal strategy.
Right.
But in reality, it's incredibly hard to pull it off, right? Like, for two reasons. Firstly, most people don't have a large lump sum sitting idle waiting for a crash, right? Like, if that was true, just before the crash, I will convert everything to cash and sit. And as soon as, the market reaches that bottom, I'll invest. Most of the investors, the reality is they're fully invested or they're building their wealth gradually from their monthly income. So for them, a disciplined contribution plan like, your dollar cost averaging or enhanced DCA is a more realistic and sustainable approach. It actually matches how people actually earn and save, right? And similarly, the second point, the timing, the bottom is nearly impossible. We all know that, right? Like fear is usually at its peak during market drops, and most investors will hesitate to act during these times. So again, when it comes to DCA, EDCA, it removes that emotional barrier by applying this rule-based system, automating your investments and increasing the amounts during meaningful declines. And it helps you do what's rational, right? Like, but you do so without those emotional biases as well. So while, yes, I agree, like lump sum investing can work if you have the cash and you can perfectly time actually, DCA and EDCA are more smarter and more accessible strategies for vast majority of investors.
Fair enough. Well, then, if an investor started EDCA during a flat or sideways market, what outcomes could they realistically expect?
That's a good question. And see, I think in this case, the strategy will typically behave more like your traditional DCA. Because if the market is not, dropping or significantly correcting, the enhanced top-ups will not be triggered, right? Because these get triggered when there is a market drop, and meaning that, you will continue to invest your regular monthly contributions. So you do as you plan and you remain disciplined and stay invested. So the returns in such a condition will not significantly differentiate versus a traditional DCA. But the key advantage of the enhanced DCA is that it stays ready to respond and you don't need to time it yourself. If volatility or a correction does occur, the strategy automatically deploys more capital at lower prices. So again, something that most of the investors like myself also struggle to do emotionally. So if I had something like this available, I'll automate my investment with this strategy because, it keeps you invested and it also helps you take advantage of any tips.
Well, looking at past major market sell-offs as well, Ritesh, say 2008, 2020, or even 2022, how did an EDCA strategy perform compared to, lump sum investing or traditional DCA?
Yeah, so most of these market sell-offs, 2008, 2020, 22, enhanced DCA has consistently outperformed traditional DCA, as well as lump sum investing, in certain cases, especially when they're followed by a recovery period, which, happens most of the time. So if you take the 2008 global financial crisis, I alluded to it previously as well, an investor who started EDCA right before the crash and stuck through it, all the way to 2014, you would have seen a return of 84% compared to a traditional DCA, which will yield you 66%, and a lump sum investing strategy, which will give you 50%, right? Because, again, you go through huge drawdowns, and then it takes time for you to recover back to, get even. And what's the reason? Again, EDCA systematically is deploying more capital when prices are deeply discounted, and something, again, investors struggling to do. And in short, it just means that EDCA doesn't just smooth volatility, it turns it into an opportunity. And by doing automatically, this investing during the dips, it reduces your average cost and positions you as an investor for stronger long-term gains, especially as you asked, when the market recovers.
So what's your take on the idea of leaning in during downturns, and how does EDCA make that easier to implement?
So in terms of leaning in, it basically, again, means that you invest more when the markets fall. And it is actually one of the most effective ways to build long-term wealth. But we have talked about it previously. As simple as it sounds, it's incredibly hard. And because most investors struggle to commit more money when the markets are falling, either it can be because of fear, uncertainty, liquidity, or just not planning for it, right? This is where enhanced DCA can come in because, if you think about, again, someone who's trying to do a monthly contribution, if they have, say, $10,000 of income, they save, say, $2,000 every month, basically 20%. They do have the ability to invest, say, $1,000 every month, which they are doing anyways. But in certain months, when the markets do drop beyond a certain point, you can stretch yourself and do $2,000 during these months. But you do it, again, in a rule-based approach. You are not relying on gut. You're automating it. And you're setting certain thresholds, right? 5%, for example. And the reality is, when you look at 5% drawdowns, it happens, usually once a year, right? If you set the threshold at 2.5%, it happens maybe 2 to 3 times a year. So you can really also think through what's the right threshold for you. But the idea is for you to kind of automate it rather than, trying to time it by yourself. And this is where EDC actually helps investors to do this lean in without kind of second guessing. And it adds that discipline, which is otherwise very emotionally difficult.
Right. And before we let you go here, Ritesh, what lessons then can we learn from past major market sell-offs and be prepared for the current one?
So a few points. Number one, volatility is very, very normal. Market pullbacks are just part and parcel of investing, right? And if you go back, multiple decades, the S&P 500 has seen a 5% pullback almost every year. So this is where I was talking to you about the threshold of 5%. You will experience it at least once a year. And a 10% correction happens roughly every 2.5 years, right? So right now, if you look at S&P 500, we are in correction territory, which is 10%. We briefly touched, bear market territory, which was 20%. And these events then, happen at a fairly regular pace and all. But that's where number two, staying invested actually pays off, right? Even though the market do experience these sharp drops, like on average, there is a 14% intra-year decline in the S&P 500. The reality is by the end of the year, most of the times, or almost 75% of the times, the S&P 500 ends up in positive territory. That means despite the noise, the markets tend to move higher over time, right? So this is something that is very important for everyone to understand, and when they are investing and all as well, because again, timing the market is very, very tough. And this is the third point, which is basically time in the market always beats timing the market, right? And consider this, an investor who put $10,000 into S&P 500 in 2000 would have, now gotten to $50,000 despite going through, the dot-com bust, the global financial crisis, COVID, as well as more recently the inflation kind of like driven volatility. And again, there is multiple, I guess, these pointers that you can look at where the best days in the market actually happen during the bear market. So 50% of the best days in the market actually happen during bear market. And this is exactly, again, what you saw last week when S&P 500 rebounded 9.5%. And if you're out of the market during that, you've just completely missed out, right? So again, instead of doing that, if you would have done your enhanced DCA in the previous days and weeks, you would have been in a much better place and you have automated your investment. And that's why number 4, it's important that you have a plan and you kind of like stick to it. And history has again shown that emotional decisions like panic selling, etc., are usually costly, right? Like, if you miss the, say, 10 best days or 5 best days in the market, you can, reduce your overall returns by more than 50%, right? Like, this is again research that has proven it. So strategies like dollar cost averaging, enhanced DCA helps investors stay committed by investing, number one, investing during the market fall and even like increasing your investment. So I guess like the point that I'm trying to make is be brave when the market and everyone is fearful. It's very important. You can then turn volatility into an opportunity. And this is the key takeaway for me, right? Like, essentially volatility is just inevitable. So if you remain invested, you stay disciplined and use smart strategies, disciplined strategies, rule-based strategies like this enhanced DCA, you're more likely to come out ahead.
Right. Well, some great key points that we can take into our investment strategies. Well, thank you so much, Ritesh, for your time and your insights today.
Thank you, Hongbin. Pleasure to be here again. And look forward to the next one.
Looking forward to one as well. Well, thank you so much. That was Ritesh Ganeriwal, who is the head of investment advisory at Syfe. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.